Residential sales comparison and income approaches, page 160. Operating expenses. Operating expenses are day-to-day costs of running a building, like repairs and maintenance, but not including debt service or depreciation. Debt service is the amount of funds required to make periodic payments of principal and interest to the lender. These are expenses that must be made by the property owner in order to adequately maintain a property at a level that it could continue to produce revenue. When income is analyzed at an annual level, as it usually is, the operating expenses are also considered on an annual basis. As illustrated earlier in this discussion regarding contract rent versus market rent, the discussion is applicable to operating expenses as well. For a market value opinion of the fee simple interest of a property using the income approach, market level expenses are used in the appraiser's analysis. As part of the diligence performed by the appraiser, he will compare the subject's actual expenses to similar properties in the market to determine if the subject's expenses are adequate at a market level. The primary tool for this analysis is the reconstructed operating income statement. Here is a sample. Now remember, that's highlighted. That's very important. Sample reconstructed operating income statement. You have your subject, 121 High Street. Comp 1 is 232 King Avenue. Comp 2 is 343 Main Road. Comp 3 is 454 Hill Boulevard. And your first line is going to be net rentable area, square feet. Your subject is 35,000 square feet. Comp 1 is 42,500 square feet. Comp 2 is 37,500. And Comp 3 was 40,000. The next line is going to be rent per square foot. Your subject is $23.50 per square foot. Comp 1 is $21.75 per square foot. Comp 2 is $24.25 a square foot, and Comp 3 was $22.50 a square foot. The next line is going to be potential gross income. Your subject is $822,500. Comp 1 is $924,375. Comp 2 is $909,375, and Comp 3 is $900,000. The next line is going to be vacancy and collection equals 10%. Your subject is $82,250. Comp 1 is $92,438,000. Comp 2 is $90,938, and Comp 3 was $90,000. The next line is going to be effective gross income. Your subject is $740,250. Comp 1 is $831,938. Comp 2 is $818,438, and Comp 3 was $810,000. The next line is going to be expenses, fixed. The next line is going to be real estate taxes. For your subject, it's $91,350. Comp 1 is $107,100. Comp 2 is $100,000, $99,125, and comp 3 was $99,200. The next line is insurance. Your subject is $2,450. Comp 1 is $3,400. Comp 2 is $2,625, and comp 3 was $2,800. The next line is going to be expenses variable. Going down the list, your first one is going to be utilities. Your subject is $81,900. Comp 1 was $108,800. Comp 2 was $100,125. Comp 3 was $92,800. Next line down is maintenance / janitorial. Your subject is $40,950. Comp 1 was $56,525. Comp 2 is $45,000. And comp 3 was $46,400. The next line is going to be repairs. Your subject is $14,000. Comp 1 is $20,400. Comp 2 is $15,375. And comp 3 was $17,200. Your next line is management fees. Comp 1, or your subject, is $8,400. Comp 1 is $9,350. Comp 2 is $9,000. And comp 3 was $9,200. Where are we at? Management fees is the next line. Your subject is, do we just do that one? Yeah, we just did that one. Other. The next line is other. Subject is $1,750. Comp 1 was $2,550. Comp 2 was $1,875. Comp 3 was $2,400. Your next area is going to be reserves. 5% of your EGI, effective gross income. The roof and HVAC for your subject is $37,100. Comp 1 is $41,650. Comp 2 is $40,875. And comp 3 was $40,400. The next line is going to be total expenses. Your subject comes to $277,900. Comp 1 comes to $349,775. Comp 2 was $315,000, and comp 3 was $310,400. The last line is going to be net operating income. Your subject is $462,350. Comp 1 was $482,163. Comp 2 was $503,438. And lastly, comp 3 was $499,600. Page 161. You will note that operating expenses have been defined into 3 types. Number 1, fixed expenses. Number 2, variable expenses. Number 3, reserves for replacement. When developing a reconstructed operating income statement, appraisers must identify certain expenses and assign them to the property category. Therefore, it is important that the characteristics of each is clearly understood. Let's discuss each expense type a little further. Fixed expenses. When one considers fixed expenses, the primary thinking should reflect on ongoing expenses that do not vary based on occupancy levels of the property. Real estate taxes and insurance on the property are examples of items that are typically considered fixed expenses. Even though the cost of these items might vary from year to year, the change is usually not significant and is not based upon occupancy. Other examples of fixed expenses might be services that are contracted at a level rate for perhaps a year at a time. A good example might be refuse collection, where the lessor is paying for a certain number of collections per week or month, regardless of how much refuse there is. Another fixed expense might be the cost of a security light for a parking area or other common area where the expense is a reoccurring flat fee. Again, think of costs not associated with the occupancy. Note, keep in mind that debt service is not an expense that is required to maintain the property. Variable expenses. Variable expenses are operating expenses necessary to the property, but dependent on the property's occupancy level. Maintenance and repairs are typically considered a variable expense, as are any utilities to the living units furnished by the lessor. Another common variable expense is management fees, often expressed as a percent. Since it is not logical that property managers or a management company are rewarded for vacant units or property, the percentage is typically based upon effective gross income rather than potential gross income. Thus, management fees are considered a variable expense since the expense varies based on occupancy. Other examples of variable expenses might be legal and accounting fees that are charged on a non-consistent basis and other miscellaneous expenses.